Forward. Nilesh Shetty from Quantum Advisors is now joining in. Nilesh, good morning. Thank you for joining in. I'm sure you heard the management of Suzlon speaking to us. Where are you placed in this entire power generation theme? You want to bet on these power generators or this equipment suppliers like Suzlon and Inox Wind, or you want to bet on the power financiers like REC and PFC? Where are you placed here?
Yeah, unfortunately, we don't have any allocation to this entire space. We used to have significant allocation to generators as well as transmission company. But again, these are regulated entities, especially on the generation side and the transmission side. And roughly they make about 15% ROE. And so now when they trade at 3 times, 4 times book, it's just for a value portfolio like ours, it's difficult to justify holding them. We've actually exited them a couple of years ago from our portfolio. I know there's a transition happening to the renewable side. So there is, especially on the grid supply or players exposed to supplying equipment to the grid, there is significant demand uptick there. But when you look at their valuations of 60 times, 70 times earnings, I think a lot of that is already discounted, and there is disappointment possibly ahead in terms of growth not catching up to valuation at the end of the day.
Okay. Nilesh, hi, welcome to the show. Mazagon Dock Shipyard is reacting to its numbers and, F&O entrant as well. But separately, how would you approach the stock given, its defense play and that the stock is already outperformed, sitting at a gain of around 60% year to date?
Yeah, so again, we do not have any allocation to the defense space as such. I at least internally, the view is global defense spending will go up. India traditionally has grown, defense spending has grown in line with its normal GDP. So there is only one big buyer in India, the government of India, and its budget goes at a certain rate. And to assume these companies can go above that is not justified. We've not significantly seen a trend where defense spending outpaces GDP growth by a material number. So in that environment, if they were to match normal GDP growth rate, to give them the kind of valuation that they're getting, rivaling consumer staple companies, it seems very unrealistic to us. So our sense is it's actually a very frothy environment for defense stocks. In this current environment, I know a lot of the money is flowing in, including a lot of sectoral funds which have been launched, which are putting money in the defense space. But once sanity prevails, I think people will realize these companies are extremely overvalued.
So where are you putting money to work, Nilesh, in a market like this, which is in slightly consolidation mode, having recovered from the lows? Where are the sectors that you are betting on right now?
So our largest allocation remains private sector banks. We continue to have a significant weightage there, where at least in terms of valuation, they're trading at far below the long-term averages. We have allocated to the insurance space as well, where we found selective stocks which came to our buying limit. We continue to have an allocation to IT services. I know there are near-term concerns on what can happen as discretionary spend slows down in the US. But if you have a sort of 3 to 5 year horizon, current valuations do make a lot of sense, where we think there's margin of safety if you're a long-term allocator. So these are the large places where we have allocated money.
Oh, okay. Just wanted to get a sense if you're looking at the entire banking space on Indescent Bank.
Yeah, we hope there is a cleanup underway. See, it's a bank which has had historical problems as well, and it was a darling of the market, but it went through a significant correction, especially after COVID, as issues on non-recognition of NPA in the microfinance book even erupted then. So, and exposure to certain groups which eroded the confidence in the market. Our sense is, hopefully, what is happening right now drives a cleanup in the bank, and valuation again remain very, very attractive. So it is a portfolio stock for us. We continue to hold it, and we think there is especially after the cleanup, once things normalize, there could be sort of a value unlocking that will happen in the bank.
Now, what about a lot of these new listings, Nilesh? Ola Electric is one of them. Losses continue to widen, although the guidance remains optimistic, but delivery or execution remains the concern. There are brokerages that are guiding for targets as low as 30 rupees on the stock. Where do you see this going for Ola, and what do you think is the key trigger now for any reversal in sentiment for a stock like that?
So we continue to actually have allocation to the traditional ICE-based two-wheeler. We reduced it as valuations became expensive. But again, distribution is such a big advantage in this space, and to create that overnight is not easy. And to be able to do after sales of all the two-wheelers in the market, which sort of helps build a brand. Again, it's a long-term process. It's not an overnight process. Some of the new players have jumped the gun and sort of flooded the market with the products, then realizing we have to service them as well. So we continue to believe that the existing players or incumbents have a big advantage, and our allocation continues to favor them over the newer players that are.
Okay, all right. Nilesh, also wanted your thoughts on a couple of these pharmaceuticals counters, the CDMO plays. They all are in focus on the possible opportunity from, say, GLP-1 drugs. So how would you play, a company such as Syngene, as well as OneSource, as well as Cohance? Are they companies that you have in your portfolio?
Not the CDMO players. We continue to have the traditional generic players. So, there were selective opportunities which came up when there was significant pricing competition in the US. Valuations for these players came off. Then we added them to the portfolio. They have done well for us. They've valued a bit. Again, there are some concerns emerging now on what can happen under sort of the new president and his policies targeting the pharma sector. But again, we favored traditional IT generic companies exporting to the US. And again, it's been stock specific. It's not that we have a view on IT generics being a place to be invested in. It's selected stocks which came in at different points in time where we found valuation comfort. We allocated them. The entire CDMO space has always been very expensive for us.
But wouldn't you take, wouldn't a pure play generics company be a risk, considering that what could emerge when it comes to Trump and the tariff situation? And from that aspect, which are the other sectors which could probably be at risk?
Again, the assumption is there are alternatives to Indian generic suppliers. We do not believe there are. I think even whatever policies come through, I think there is no alternative available to Indian generic suppliers in the US. And I think if there are tariffs imposed, I think Indian manufacturers will find a way around it, by either passing on the cost or absorbing some of it. And some of them have already created manufacturing bases in the US. So our sense is that the discount and valuations that they're getting for the perceived risk may not be best at all.
All right, Nilesh, thank you so much for sparing time and joining us today. Look forward to having you more often on this platform. Take a short break. On the other side, we continue our conversations on the markets. But just before we do that, we are excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset and for the Global Lens at 8:30 p.m.